Yeah, I think it's the first time I've seen you without a mask on.
Yeah, I'm alone today, so I managed to take it off and not endanger anyone.
Okay, folks, welcome. It's as people join in. I thought I'd kind of review what's left of the class because there's a week of class left. I mean, it's amazing. We're at 3 sessions left, final exam, final project, last couple of things. So, a couple of things. One is I've been repeatedly nagging you, harassing you about entering your numbers into the Google shared spreadsheet as you get the numbers for your company. I know I'm asking for a lot of numbers. I'm sorry, but I need those numbers for next Monday's class because here's what's scheduled. Today, we're going to finish up dividend policy and we'll get started on valuation. Wednesday, we're pretty much going to be done with valuation. We're going to be done with the entire packet. So all our lecture notes are going to be done, which leaves you with what are we going to do Monday? Leave that to me because Monday I call it my grand finale. So basically everything we've done in the class, I'm going to use your project numbers to kind of review. So think of it as a review session, a journey through the project, the entire class, all kind of summarized in that session. But for that session to work, I need your numbers. I need your numbers in your beta, your Jensen's alpha, your optimal debt ratio. So if you can supply me with those numbers, it makes my job much, much easier. So as you get the numbers, if you can go fill in that Google shared spreadsheet, I'd really appreciate it. Any questions before we start? So the numbers need to get to me obviously before next Monday, preferably Saturday, maybe even Sunday. The project itself is not due till 5 p.m. on Monday. So it's due after class. So, and I'll send you more specifics about how to direct the project because next week is going to be a week from hell for me in terms of submissions because I have 3 classes all submitting projects. I want to make sure they go to the right place. So I will send you more directions on how to submit the project so that I get it back to you. No, any questions? Your final exam is, I think, scheduled for Monday the 17th. It will be accessible for 12 hours that day. And again, it's a 2-hour final. It's cumulative, but don't let that intimidate you because things build up. You'll notice that as you do valuation, you're reviewing investment analysis, you're reviewing cost of capital, everything builds on everything else. It's not a collection of 15 topics. Now, but basically it'll be 2 hours. It'll be the same structure as the quizzes. And as with quiz 3, I will have that option for those of you who feel uncomfortable with multiple choice of taking the quiz as an open answer quiz. So that's, I'll set up the Google shared spreadsheet as well. So with that set behind us, let's talk about dividends. If you remember the last session, I talked about Disney. I talked about Disney in 2003, where the company was in trouble. Its returns were lagging the cost of capital. The stock had not done well, and it had a CEO that nobody liked. And I said, Disney in 2003 would have had almost no power to change its dividend policy. It had lots of pressure to return cash because nobody trusted the company. Then we move forward to 2009. A new CEO has come in, a guy called Bob Iger. He's changed the company. The company's doing well. It's delivering more than the cost of capital. The stock has done well. And I said the freedom to hold back cash is now in Disney's hands. And essentially the point I was trying to raise was you earn the right to accumulate cash as a company. And the longer and the better you do as a company, the more cash you can accumulate. That explains why a company like Google can accumulate 100 billion in cash. And nobody raises their voice and say, look, I want the cash back. So today I want to talk about my other companies. So let me move on to Vale. Vale, if you remember, Brazilian iron ore mining company. This is in 2013. I computed the free cash flow to equity, and you can see already that we're going to be in a little bit of trouble because the free cash flow to equity that I got, both pre-debt and after debt, were negative. So think about it. Even before I even look at dividends, they're in the hole. They have negative free cash flows to equity. And if I asked you how much cash can a company with negative free cash flows to equity return, that sounds like a silly question. Of course, you can't return any cash. You have negative free cash flows to equity. But look at what Vale actually did. They actually paid out about $29.6 billion in dividends and buybacks. In fact, a big chunk of that was in dividends. You have negative free cash flow to equity. You're paying out huge amounts in dividends and buybacks. Do you have a dividend problem? Of course you have a dividend problem. You're paying too much in dividends. Now, often when you run, some of you might run into companies which are doing this, and why don't they stop? Why can't they just stop paying dividends? In the case of Vale, let's see what the problem is going to be in trying to get them to pay less in dividends. So I'm going to play the role of Vale CEO. You're going to be Vale shareholders. I'm going to come in front of you and ask you for permission to cut dividends. Looks like I have a pretty solid case, right? I am paying out far more than I can afford. Everybody can see that. So I tell you, look, I'd like to cut dividends. Before you say yes or no, I'm going to give you a little bit of added ammunition as shareholders. I'm going to take you back to the corporate governance section. Remember in corporate governance, we talked about Vale having two classes of shares. Common shares, which have voting rights, and preferred shares, which have non-voting rights. The preferred shares in Vale are really common shares without voting rights. Guess which one most of you hold? You hold the ones with no voting rights, the common shares without voting rights. In return for not giving you voting rights, here's what Vale has done historically. They promised to pay a fixed dividend. They promised. And if they don't pay the dividends, guess what happens? You get voting rights. So as a CEO, I get up in front of you and said, no, look, we can't afford to pay these dividends. We'd like to cut dividends. So William, I'm going to ask you the question. You're a shareholder. You have no voting rights. You've been receiving dividends. I've convinced you I cannot afford to continue to pay these dividends. I'd like to stop paying dividends or reduce my dividends. What are you going to demand in return?
Am I going to demand in return? Maybe deferring payments or something like that. A promise that they'll go back later in.
I'll give you all of those. That'll let me off the hook, right? So you can say, why did you demand a dividend in the first place? Because you didn't have voting rights, right? I made you a second-class citizen, and then I said, be a second-class citizen, I'll pay you this dividend. Now I'm asking that not to pay the dividend. So I would assume you'd want to become.
You'd want voting rights. So.
Exactly, you're going to demand voting rights. And this is at the core of the problem for many companies, is for them to adjust their dividends, they have to give up control. And across Latin America, this plays out. So would you rather cut dividends or do you rather give control? Guess which one Vale would have gone with in 2013? They said, we'd rather hold on to control and continue to pay these insane dividends. This has been happening for years leading into 2013. And this is exactly the problem when control becomes the dominant objective in companies. Matthew?
Yeah, Professor, I have a question about the previous slide, the free cash flow to equity.
Yeah.
I'm sorry if you went over this, but could you repeat what free cash flow to equity pre-debt versus actual debt is, like the distinction there?
Okay. Free cash flow to equity pre-debt is net income plus depreciation minus capex minus change in working capital. I stop there. So I'm stopping, if you think in terms of the statement of cash flows, right after the investing section. So if you think about in a statement of cash flows, you have operating cash flows, investing cash flows, and financing cash flows. I do just the operating and investing cash flows. Basically, I said, this is my free cash flow to equity before I even look at debt. So that's a pre-debt number. The post-debt number, I look at how much new debt you raise, which is a cash inflow, and how much debt you have to repay. So the post-debt number, I've essentially taken the debt issuances and the debt repayments that you have in the statement of cash flows and brought that into my free cash flow to equity. So if you raised $1 billion in new stock, that comes in as a cash inflow. If you had to repay $1 billion, that shows up as a cash inflow. That's a post-debt number. The target debt ratio, I ignore what you show as debt in your financing, but I say, look, you told me that 25% of your capital always comes from debt. Therefore, I'm going to net out 25% of your reinvestment as debt. So the three numbers are basically all trying to do the same thing, but they're trying to either smooth things out or look at things before debt payments. In fact, if you, this free cash flow to equity pre-debt is what Warren Buffett calls owner's earnings. It's net income plus depreciation minus capex minus change in working capital. So it basically says, I'm an equity investor. I'm not going to use debt to pay my dividends, but I want to make sure my operations produce enough cash flows to pay my dividends.
Okay, so, all right.
So the only reason free cash flow to equity when you use the target debt ratio is so much more positive is Vale raised its debt ratio, which means that if I count that in, that's more cash coming into the company because they want to move towards that 40 or 50% debt ratio.
Got it. Yeah, so that would be recapitalization if the free cash.
Exactly. So if you have an under-levered firm, this is what you're going to see in the years after. If you decide to move up to your optimal, is you're going to get that high free cash flow to equity being sustained by the fact that you're borrowing money now to get to your optimal.
Okay, but if you're over levered, then you're
it'll be a drain. So it'll cut the other way. Exactly, it'll cut the other way. So for over-levered firms, using the target debt ratio will give you worse cash flows. If you're an under-levered firm, free cash flows to equity would be much higher.
Okay, thank you.
So that's the Vale problem. It's a problem that's replicated across Latin America, because across Latin America, what you see in Vale, you see in company after company, voting shares, non-voting shares. Could that happen in the US? Until 30 years ago, US companies have two classes of shares. Today, of course, that's par for the course, especially with young technology companies. Right now, this is not an issue. Why? Because right now, these companies don't pay dividends to anybody. But you could see why this could potentially become an issue as you go down the road, as these companies age, as they have to pay dividends, as to deciding whether they value control more or whether they value having a sane dividend policy more. Oh, one more. So let's build on this theme of dividends and payout ratios. A few years ago, there was a French election, and I forget 2000, early part of the last decade. And in the election, one of the sides, I don't want to take sides, but one of the sides was running for president said that it would be good to mandate that every company be required to pay out a certain percentage of its earnings as dividends. So they wanted to create a government rule that said every company, if it's a publicly traded company, which has net income, has to pay 30% of its net income as dividends. Now, I think it's a terrible idea, but let's think about what kinds of companies will be hurt the most by passing a rule like that. Let's say tomorrow, the US government said, every US company that makes money has to pay out 25% of its net income as dividends. Let's think about what kinds of companies would be hurt by that rule. And I'm going to list out 4 groups of companies, and you tell me whether this group is going to be hurt or potentially helped by the rule. What about large companies making huge profits? Will they be hurt by a rule that requires 25%? So Shanti, you're nodding your head no. Tell me why not.
They have enough cash flow to pay out as dividends.
And even if they paid out too much, what could they do? They're large companies, you can go out and raise capital. So large company says, okay, it's a little bit of an inconvenience, not a big deal. How about small companies losing money? Michael, what do you think? Helped or hurt by this rule?
I would say hurt a little bit, but not crazy, just because they're a small company that's already losing money. Maybe it's time
wait, you said losing money. What does the rule say that you have to pay 25%? If you're losing money, who cares, right? So if you're a small company losing money, you're saying, I don't care. At least for the moment. You might care in the future, but right for the moment, you're saying, I don't care. High growth companies are losing money. Again, you say, I don't care, I'm losing money. But if you're a high growth company making money, a Salesforce, a VMware, do you see why this is going to be damaging to you? Because even though you're making money, your net income is positive. That's what we define as making money. What are your free cash flows to equity going to look like for a high growth firm? It's going to be negative. And what am I doing? I'm requiring that you pay dividends, and you don't have the kinds of access to capital that a larger, more mature company might have. I'm actually doing damage to you. Now, this is why when governments talk about changing laws, there's no consensus among companies. In fact, if I'm a large, mature company, I want laws like these passed. You know why? Because it handicaps my competition. It makes it much more difficult for them to encroach on my business. Because it basically says, look, you're not going to have the cash flows to service your growth. So whenever you hear about laws that restrict access to capital, reduce access to capital, it's not equal across companies, the effects. The effects are worst on younger companies, higher growth companies, because these are the companies that need the cash the most and often have the least access to capital to be able to service that growth. Conversely, what if I had a law that says every company should reinvest 50% of its net income? I heard this last year. In fact, during the election, there were a few people who said the problem with US companies is they're returning too much cash to stockholders, not necessarily in dividends, but in buybacks. And this is hurting US companies because that cash should have been reinvested back in the company. Sounds good, right? Because implicit in that statement is the assumption that when companies buy back stock and return cash to stockholders, what do stockholders do with the cash? That they spend it on frivolous things like big dinners. But guess what happens to 90% of the cash, or even 95% of the cash that gets used in these buybacks? You know what happens to it? It gets reinvested elsewhere. Elsewhere, where other companies that might need the capital. Would you rather that United spend hundreds of billions of dollars building more aircraft, or Marriott building dozens more hotels that nobody stays at, than that capital leaves the company and goes to an Airbnb or an Uber? You might not like their business models. But when you restrict how much companies can return, just like putting mandates on forcing them to pay out dividends, you're not creating a capital allocation that makes everybody better off. In fact, it makes everybody often worse off because it forces companies that don't have investments to continue to invest back in the business. So mandates either requiring dividends or requiring reinvestment are a bad idea, because this is something that has to be done company by company. Let me move on to a case. And here I'm going to pull in a company that's actually not part of the one of the companies that I look at. And the reason I picked this company is about 30 years ago, I was asked to come in and do this session for British Petroleum. And it was a session for about 20 engineers that they'd pulled in from around the world. And my mission was a very simple one. I was given these 20 engineers for 2 days, and I was told to teach them all the corporate finance they would need to know to become part of management, because BP wanted these engineers to come into the management team, work up the ranks, but these were pure engineers. They knew their engineering really well, but they had absolutely zero background in finance. One of the easiest classes I ever taught, because these guys were really good with the numbers. And after about 30 minutes, they said, this is all there is in corporate finance. They got really good at it over the next 2 days. But the company that I used as part of that session was British Petroleum. I said, this is a company you relate to, you work to. So rather than using Disney for 2 days, let's talk about BP. So I did everything I did for Disney. I did BP's cost of capital, their beta, their bottom-up beta, their capital structure. And then I got to the dividend policy, and I thought I'd screwed up big time, because I did what I'm asking you to do, compute a free cash flow to equity and compute a dividend. And here's what I saw. I saw free cash flows to equity, and this is between 1982 and 91, of $571 million a year. That's on average. If I asked you how much can a company with $571 million in free cash flow to equity afford to return to its shareholders, the answer is $571 million. But they managed to return almost $1.5 billion every year for 10 years. In other words, they were returning about $1 billion more every year than they could afford to. Now, one of the things I looked at is what Matthew suggested. Maybe they were underlevered. Maybe they were borrowing money because they wanted to move to an optimal. But British Petroleum was the most hopelessly over-levered oil company in the world by the time they got to 1991. So it wasn't a leverage issue. It wasn't a cash flow issue. The question was, why would they be doing it? Now, I don't know how it got started, But you can see why once they got started, it was very difficult for them to step away from this problem because everybody at BP knew there was a dividend problem. In fact, when I brought it up to the 20 engineers, when we got to the dividend section, one of the engineers said, we pay too much in dividends, right? And I said, how do you know? He said, we feel it every day because when we put out a requirement for something on a budget, they say we can't pay it this year, or we can't afford that this year. And we ask managers why, their answer is very simple, because we pay too much in dividends. So everybody at BP knew there was a dividend problem. So the question is, why wasn't something done about it in 83 or 84? Because this is a problem that's been building up for 10 years. To see why nothing happened, let me take you back maybe midway through this period, 1987. You're at a top management meeting at BP. You're all sitting around a big table, Lord so-and-so, Viscount so-and-so, and you. And you pipe up, you say, look, we have a dividend problem. Or if you want to sound British, old boy, we have a dividend problem. Everybody, aye, everybody agrees. We need to do something about the dividend problem. Aye, everybody agrees. Let's cut dividends. Aye, everybody agrees. Consensus reached, right? And then somebody raises the question. You know what the question was? Who's going to tell the shareholders? Who's going to get in front of these shareholders and say, look, we're going to cut dividends? You're saying, what's the big deal? Remember, I described people who like large dividends as addicts. They love their dividends. You've got to get in front of these shareholders and tell them they're not going to get their dividends. And as I said last session, that conversation is not going to go well. When somebody brings up this question, everybody says, not me, I'm going to have laryngitis 6 months from now. I'm going to be in the Caribbean, I won't be there. So finally, in every meeting, there's a facilitator. You know what he says, right? Let's wait a year, maybe something good will happen. For an oil company, what is something good that's going to solve your problems or make it all disappear overnight? Priyanshu?
Increase in oil prices.
There you go. If oil prices go up, there goes our problem. Let's get down on our knees and say, please, God, let oil prices go up. There was a brief period in 1991 when BP thought their problems would all go away. This was when Saddam Hussein wandered into Kuwait. There was a little war. The oil price, I think, doubled over a period of 6 weeks. You can see people in BP dancing on their desks. No more dividend problem. No more dividend problem. But 6 weeks later, oil prices had come back down. The dividend problem was back. This is, if you presented this as a case, this is a classic dividend problem company. Everybody will agree this company is paying out too much dividends. So cutting dividends is the right thing to do, right? So let's see what happened when BP had to cut dividends. And you know why they had to cut dividends in 1992? Remember how they raised the billion in dividends every year that they couldn't afford? They went and borrowed money and borrowed more money and borrowed more money. In 1992, when they went to borrow money for the nth time, banks finally said, no, we can't lend you the money. You're already the most over-levered oil company in the world. We're not lending you the money. So BP was forced to cut dividends. Keyword is forced. They didn't do it voluntarily. They were forced to cut dividends. And this is actually the news article from the day that they cut dividends that I've saved for almost 30 years now. You see what it says? BP shares plummet after dividend is slashed. That's not reward, right? They did the right thing finally for all the wrong reasons, and markets seem to not like it. Let me finish the story though. This is what happened the day they cut dividends. 6 weeks later, the stock price had fully recovered. And in hindsight, this action saved BP as a company. But here's the rest of the story. In those 6 weeks, what was happening? Remember those dividend addicts who had held on to the stock? They were selling the shares and leaving because this wasn't their company anymore. A new group of investors was coming in, a much healthier investor base. But that transition doesn't happen overnight. It takes time. And there was a lot of blood on the streets. Those shareholders who were leaving took half the management team with them. It's like a French Revolution. They took them guillotine. Basically, their response was, you guys got us into this mess. You deserve to lose their jobs. And you know what? They deserve to lose their jobs because they put this decision off too long. If they'd taken this decision in 86 or 87 or 88, they'd have had a chance of surviving. Because they waited till it was thrust upon them by the market, they essentially lost control of the process. To me, BP is always the case I think about whenever I see a company pay too much in dividends and you go to management and they say, well, let's wait, maybe something good will happen. And my response is, do it now when you still control the narrative. Do it now so you can spin it at least. I mean, people might not believe you spin entirely, but at least you have a shot. But if this is forced upon you, you've lost control of your story, and you're going to see the repercussions both in corporate governance and your stock price. Because when you want to cut dividends, if you have time as your ally and you have a story, there are ways in which you can frame it at least in a way that the effects are less damaging to you. In fact, what I have in this table is what happens when companies cut dividends. On the announcement date, the effects are pretty much negative for every company. Because no matter what story you spin, investors don't believe you. So when you cut dividends, even if you, but if your dividends are cut in conjunction with bad news, like bad earnings reports, the damage continues because people say, I know why you cut dividends, you had a terrible year. That's why you cut dividends. But if you can package your dividend cut with an investment announcement that says, look, we're cutting dividends because we plan to invest in this new business. Remember, we talked about telecom companies in the late 90s. If I'd been advising these companies, my advice would have been cut dividends, but while you're cutting dividends, package that announcement with the plans you have on how you plan to expand in these technology businesses. Doesn't mean that the stock price will not drop, but if you look at what happens if on companies that announce investment opportunities, now, by the time you get 1 quarter after the dividend drop, the stock price has fully recovered and new investment bases come in. Now, I hate to pick on Michael because he asked me the question about dividends on Coca-Cola, but Michael, do you want to bring in the class on where Coca-Cola stands in terms of dividends and the question you asked me?
Yeah, sure. So Coke has famously been increasing its dividend for the last, I think it's 59 years. They've increased dividends, and as a payout ratio to free cash flow over the last 10 years, they're at 120%. So they have the cash to cover it, so they don't have to borrow it necessarily, but their target payout ratio is 75%. So they're above that.
So if Coke had to cut dividends, what would they need to package it with to get at least a chance of getting a positive reaction?
A lot of new investments, new growth.
In something that you believe in, right? Maybe it might be healthy. I mean, they've tried this. They've tried healthy water. They've done a couple of acquisitions in expensive, healthy water. I don't even know what that means, but you know what I'm talking about, right? The water that you pay $2.50 for a bottle of water for. But if they want to cut dividends, they've got to think through the packaging of this dividend cut. And it's got to be real. It just can't be cosmetic. It has to be something real you're going to do with this cash that people believe you have a future in. And that's what, I know some of your companies have dividend problems. They're paying out far too much in dividends. And you're saying, what do I do now? Announcing an abrupt cut is not going to do it for you. It's just going to mean your stock price implodes. But finding a way to either do it over time or packaging it with something that markets will find attractive at least gives you a shot of getting a reception that's a more positive one. Any questions about cutting dividends? Go ahead, Dwanish.
I just wanted to ask if the same reaction or a similar reaction is seen when companies announce that they're going to be cutting buybacks instead of dividends?
No. And you know why? Because people don't expect you to continue to buy back stock. And that's the advantage of buybacks. It's flexible. So in 2020, for instance, a lot of companies announced cuts in buyback and people said, okay, that makes sense. You're in a bad year. So the fact that buybacks are viewed as temporary, I think, is a big factor in why the reaction is not as negative. And it also explains why companies, if they have the cash, then are more likely to embark on buybacks rather than dividends today. It's a hidden reason why 2/3 of the cash returned in 2019 took the form of buybacks, is companies are shifting away from dividends. Kushal?
Professor, is it reasonable to expect a similar reaction to dividend cuts for companies that have suspended dividends during COVID and just elect not to resume for the next, let's say, 4 or 5 years?
You know what? That's a good question. A lot of companies got a nice excuse. We had a bad dividend policy. 2020 gave you the excuse, right? You just said, we cut dividends because of COVID. I would say keep using that excuse. It worked. Act like it's still there, because you have an opportunity now to restart your dividend policy. And you might decide that what you were doing pre-2020 didn't make sense to you. So if Coca-Cola ever wanted a chance of doing this, 2020 was it. That chance has passed. But I think that's a very good point, is many companies suspended dividends. For instance, I think airlines have no business paying dividends. They're in a risky, uncertain business. Now, if they want to return cash, they're far better off doing it in the form of buybacks. So if I were an airline, I'd say, once you used 2020 to cut dividend, to stop dividends, everybody understood why you did it. Now you get a chance to restart your dividend policy. It's a gift. Take advantage of it to reset your dividend policy at something that makes sense. And that's why my prediction is going forward, you're going to see even less in dividends relative to what you did pre-2020, because a lot of companies that suspended dividends are going to say, this is good. We're going to return cash, but more in buybacks than in dividends. So I wouldn't be surprised if you saw dividends become 20% instead of 1/3 of the cash flows returned by US companies. Let's move on to any other questions on. No. Let's move on to a fourth case. This was again in 1992. I was looking at the Limited. You've all seen the Limited stores, right? But this was a very different time. The Limited was one of the fastest growing, most successful retail experiments out there. This was a Gap and the Limited were growing. They were taking business market share away from department stores and people who stuff. So think of this as the high growth phase of the Limited. And during this high growth phase, their free cash flow to equity was minus 34 million. Why was it negative? Well, because they were growing. They were reinvesting. They were opening new stores, negative free cash flow to equity. But they actually had dividends on average of 41 million a year, every year. And I'm going to come back and talk about how they got started on paying dividends during a high growth phase and why I think that's a very dangerous thing to do. Incidentally, during this period, the Limited also had great investments. The return on equity was exceeding its cost of equity. So basically, it was a good company with lots of growth opportunities that were paying, that was with negative cash flows to equity, but was paying dividends. That's a kind of a puzzle. Why would you be paying dividends if you have great investments and you have negative free cash flow to equity? I don't know the story behind it, but I'll guess. Sometime early in the 1980s, the Limited was probably visited by an investment banker. I'll be the investment banker, you be the Limited. I'm going to give you the sales pitch that's going to lead you down this path of doom. And here's what I tell you. I tell you, look, you're a high growth firm, but you're not paying dividends. So this was 82 or 83, you're growing, you're not paying dividends. You're making money, but not paying dividends. And I said, there are some investors out there who cannot buy shares in companies that don't pay dividends. Is that true? Yeah, there are pension funds, for instance, that cannot, and especially in the early 80s, that was true. About 40% of big institutional investors would not buy shares in companies that did not pay dividends. So I encourage you, I say, look, pay a token dividend. Just pay a small dividend. I know you can't afford it, but what's the harm in paying $1 million in dividends? What do you gain by doing it? You now show up as a dividend paying company, and that 40% will now potentially be able to buy you. Demand for your shares will increase, your stock price will go up. Sounds alluring, right? You see how when you're a young growth company with negative cash flows, you listen to that sales pitch and you say, hey, maybe I should pay a token dividend. Liz John, what's the problem going down this path and paying just a tiny dividend?
I think then the investors would expect that in perpetuity.
It's like offering an addict a little bit of cocaine. Just take a little bit, but stop right there. It doesn't quite stop with a little bit, right? You offer a token dividend, people get the dividend. What do they want? They want more. And that's exactly what happened at the limit. They started with $1 million in dividends in 83. By the time they got to 1992, they were paying $101 million in dividends. If you cannot afford to pay dividends, don't get started. Why do you want investors who like dividends if you're a company that can't afford to do it? You're attracting the wrong investor base. If you're a high growth company, there are plenty of investors out there who don't want dividends. That's the investor base you want. So one of the things you have to worry about is if you develop an investor base that is not right for you as a company. That's not helpful. In the long term, it's going to come back to hurt you. One final example, let's take Tata Motors. Remember, let me remind you again, Tata Motors is part of a family group of companies. Why does it matter? When it came to capital structure, you saw that Tata Motors was over-levered. And one reason I gave was, hey, they can afford to borrow money using TCS's debt capacity, even though that they're a separate company, because bankers think they're lending to the family. They're not lending to an individual company. So when I looked at Tata Motors' free cash flow equity, the free cash flow equity pre-debt was a huge negative number. Now, if you brought in the actual debt, or if you looked at the actual debt, was a huge positive number. But use the target debt ratio is about 48 billion rupees. The actual dividends and buybacks were about 75 billion. They were returning more in dividends, mostly dividends because they didn't have any buybacks, than they had available. Again, if this were a standalone company, what would you advise them to do? Don't pay those dividends, right? It doesn't make sense. Cut your dividends because you can't afford them. But remember, they're part of a family group of companies. One of the things about family group companies is, remember, shares in the company there are a lot of internal holdings. So what Tata Motors pays as a dividend actually becomes a cash inflow to TCS and to the other companies holding shares in Tata Motors. Again, all I'm saying is, while as an individual company, it's easier to make decisions on what to do, when you're part of a family group of companies, you have to wonder who's benefiting and who's paying. I mean, as an investor, you'd rather they cut dividends, but you can see why companies can end up showing dysfunctional dividend policies on their family group companies because the cash gets moved around companies within the group. So here's the bottom line. Compute the free cash flows, equity, and dividends for your company. Don't do it in 1 year, especially if it's 2020. Right? Strange things happen in 2020. Look across time, make a judgment. Just like Michael did, on average over the last 5 years, the last 10 years, am I returning less than my free cash flow equity, roughly my free cash flow equity, or more than my free cash flow equity? Also look at their project choices. Are they picking good projects, neutral projects, or bad projects? Make your best judgment on where in this matrix your company falls. So if you look at my companies, now, Baidu is the only company which gets maximum flexibility. It's got positive free cash flow equity, pays no dividends, takes great projects. It's a company that's least likely to feel any pressure to return cash back. If you look at Deutsche Bank, it's in the worst possible quadrant. Bad projects and returning too much cash. I'm not even sure where to start with this company, because if I just ask them to pay less in dividends, they're going to find more bad investments to make. But I have the biggest bundling of my companies in this quadrant, where Disney, Vale, and Tata Motors are all returning more than their free cash flow equity as dividends. But they're also companies with good projects. So I worry about the damage they're doing to themselves. So, the final thing I'm going to check out, whether these companies are under-levered or over-levered. Why does it matter? If you're paying more than your free cash flow equity as dividends and you're under-levered, I'm going to cut you some slack. Why? Because this is how you move to your optimal debt ratio. But in the case of Vale, not only are they paying out more than their free cash flow equity dividends, they're over-levered. Every time you do this, you get even more over-levered. Vale is moving further away from its optimal, getting more over-levered every time it does this. Disney at least is moving closer to its optimal. So I'd be much kinder to Disney than I am to Vale in making that final judgment. Shreya?
Wouldn't a bank have covenants about paying out dividends? So if an over-levered company is sort of borrowing money and then paying out dividends.
Here's the most unfair thing about banks, right? One is if you're a small business borrowing or a small company borrowing money from a bank, it's very likely you have covenants. If you're Vale or Disney borrowing money from a bank, you usually don't. You know why? Because you view it as a big company, an adult company. And in fact, remember, Disney gets almost all of its debt from corporate bonds. There are no dividend covenants in most corporate bonds. So when you look at these companies, the kind of covenants they operate under often get less stringent as they get bigger as companies. So it's a rare company that's stopped from paying dividends by a bank covenant. So it's only really small companies we're going to see that happen. So let's review what you're going to do if you haven't done your dividend policy. One is you're going to start by looking at your company's dividends and buybacks. The place to find them is in the statement of cash flows. So you don't have to go looking. Look at the statement of cash flows because dividends and buybacks have to show up there. In the same statement of cash flows, you can compute the free cash flow equity, the net income, the reinvestment, the debt. You can do it before debt and after debt, just like I did, and maybe draw your own conclusions about which one you're going to focus on. And then ask yourself, do I trust the management of the company by looking at their Jensen's alpha, the project returns? But ultimately, that's the end game in dividends, is to ask, do I trust this company enough to leave them with my cash? Any questions on dividend assessment? Now, remember with capital structure, I said the primary way in which companies decide how much to borrow is not by doing a cost of capital approach and seeing where the cost of capital is minimized. It's by looking at what everybody else in the sector is doing and trying to stay as close as they can to those people. Well, guess what drives dividend policy? It's basically Me Tooism and inertia. Basically, this is what we've always done. Why does Coca-Cola continue to increase dividends? Because it has this tradition. In fact, it states it, saying we have a history of paying more in dividends. And you know what? They're locked into a policy that they're now going to have to follow, whether they like it or not. Inertia is strong in long-standing companies. The more successful you've been, the deeper the inertia is, because it's worked in the past. So one way to assess how much a company should pay in dividends is to look at what everybody else is doing. So let me take a first shot at it. I took my 5 companies, Disney, Vale, Tata Motors, Baidu, and Deutsche Bank. I defined a peer group, and that's a judgment call. With Disney, I said they're compared to entertainment companies, with Vale, with diversified mining companies globally. So I listed out my peer group. And I looked at the dividend yield and the dividend payout ratio of that peer group. So let's take Disney. 1.09% dividend yield, that actually puts them higher than the peer group. The peer group's average is 0.96%. Disney's payout ratio is about 22%. If I didn't know better, I would say Disney's dividend is set on autopilot. They look at the industry average and they try to trade because it looks incredibly close to the industry average. If I look at Vale, much higher dividend yield than the typical company. And a payout ratio greater than 100%, but the entire sector is insane. They're all paying out more than their earnings and dividends because it was a year in which commodity prices were down. When I look at Tata Motors, dividend yield of 1.3%, payout ratio of 16%, that puts them slightly below the automobile companies. So in the peer group comparison, all you're doing is you're looking at your dividend yield and payout for your company, comparing it to the yield and payout of the peer group. In case you're interested in finding out what your company's peer group looks like, you can cheat and you can go to my website. I have industry averages for payout ratio and dividend yield for about 100. Pick the industry that best fits what you would compare your company to and just make a direct comparison. But if you truly want to get past just industry averages, you really want to look at how your peer group is setting dividends, you want to take a closer look, right? The industry average for entertainment companies covers a lot of differences across those companies. In fact, let me show you where my industry averages come from. These are my entertainment companies. You can see the average is what I report, but the numbers are wildly different across different companies within the group. There are entertainment companies, a lot of them pay no dividends. There's at least one that pays a 4.39% dividend, that's Regal Entertainment Group. And there are companies that pay very low dividends. So remember with capital structure, we looked at a peer group and he said, what can I learn from the peer group? One of the things you can do here is rather than compare the average, you can say, you know what? The average is very diverse here. There are small entertainment companies that pay no dividends, much larger ones that pay dividends. Maybe I can see what drives dividends across this. I tried a regression with this. Nothing really worked. I mean, there's nothing in the entertainment sector that I could use to explain differences in yields and payout ratios. If there were, I might have been able to do that to come up with a predicted yield and payout ratio for Disney. But I did have a regression that I ran for the entire market. So this is all US companies. I took dividend yields and payout ratios. And in 2014, I ran regressions against beta, growth, and debt ratios. Let me explain my rationale. High risk companies, I would expect to pay less in dividends than low risk companies. The coefficients bear me out. High growth companies, I would expect to pay less in dividends than low growth companies. And again, the coefficients are negative, bear me out. And companies that borrow money should be able to afford more in dividends than companies that don't, and the coefficient bears me out. R squares are nothing to write home about, 20 to 25%. Again, that's not in my control. It is what it is. But if I can take this regression, that tells me in January 2014 how US companies decide how much to pay in dividends. So you know what I did? I took Disney's numbers for beta, growth rate, and debt to cap ratio. I plugged it into those two regressions you saw on the previous page, and I got predicted predicted dividend yields and payout ratios for Disney. My predicted dividend payout ratio for Disney is about 27%, given its growth rate, beta, and debt ratio. That is the dividend payout ratio I'd expect to see for Disney. Their actual debt ratio is 22%. I'm not going to freak out. That's close enough that I can say they're pretty close to what I'd expect. With the dividend yield, if I plug in the numbers, I get a predicted dividend yield of 1.4%. Their actual dividend yield is 1.09%. Given how other US companies are paying out dividends, I would, and looking at Disney, it looks to me like Disney is paying a little less in dividends than the typical company. It's kind of a growth and risk adjusted prediction. I'm just not comparing to the industry average. The one caveat here is this just looks at traditional dividends. And if you remember, Disney returns for every dollar in dividends they return $4 in buybacks. So I might be drawing the wrong conclusion by focusing just on dividends. But that's something to look at, is look at what the rest of your sector is doing to make a judgment on why your company is doing what it is. Okay? So if you're in a sector where nobody pays dividends and nobody buys back stock, don't be surprised if your company, even if it has positive free cash flow to equity, is very reluctant to either pay dividends or buy back stock. Any questions about peer group comparisons? So now we're on to the final phase. We've talked about the investment principle, the financing principle, the dividend principle. But in doing all of this, remember, the ultimate objective we had was to maximize the value of the firm. And I'll make a confession. I've talked about maximizing value all through this class, but we've never really got our hands around exactly how to value a company. I've held it off till the very end because, in a sense, everything we've talked about so far in corporate finance is going to come into play when we think about valuing a company. I know some of you in my valuation class, you've gone through that torture that I put you through to value a company, but I want to give you kind of a compressed version of the valuation class. For those of you who've decided this is it, you're never going to take another finance class, I want to at least give you enough valuation to make you dangerous. Now, often when you think about valuation, you think about spreadsheets, you think about input items, because a lot of valuation has become financial modeling. So I'm going to start off by framing how you can put a number on a business. Ultimately, there are three and only three ways you can put a number on a business. The first is to do what's called intrinsic valuation. What is intrinsic valuation? It sounds fancy, but you try to value a company or a business based on its fundamentals, its cash flows, its growth, its risk. Now, normally the way this shows up is as a discounted cash flow valuation. So when somebody says they're doing a discounted cash flow valuation, they mean it. And you're going to see in a minute why I said they mean it. Then what they're trying to do is do an intrinsic valuation of your company. The second way you can put a number in your company is by looking at what other people are paying for similar companies. It's called pricing. And the way this usually manifests itself is to come up with the pricing for a company, pick a multiple, price earnings ratio, EV to EBITDA, EV to sales, some kind of standardized price. And you find these 15 or 20 other companies that you say are just like your company, your peer group. And you say those 20 companies on average are priced at 20 times earnings, a PE ratio of 20. So my company should be priced at 20 times earnings. Implicitly are assuming that markets are right on average and that you can use that market pricing to price your company. So you got valuation, you got pricing. Once in a while, though, you might run into a company where the number you see attached to the company doesn't come from either intrinsic value or pricing. It comes from something contingent happening. I'll give you a classic example. 2 years ago, if you'd been valuing Moderna, or last year, before the COVID, one of the things you'd have been valuing is a vaccine that was working its way through the pipeline, that hadn't been approved yet, but potentially had a huge amount of promise. We didn't realize how huge the promise was, of course, before COVID, but basically you are valuing a drug that hadn't been approved, but there were a lot of contingencies that had to come into play. To get approved, it had to be commercially useful. You are in effect valuing a contingent asset. It's a fancy word for an option. It's called real options. We talked about real options in the context of investment analysis, but there are some companies where you're not buying a traditional intrinsic value or pricing, you're buying a real option. We're not going to talk about that in the context of this class, but we spend time in the valuation class talking about young pharmaceutical companies, natural resource companies. We can use an options argument. But most of the time, your choice is, do you want to value something or do you want to price it? And you got to make that choice up front. You can't go back and forth because it requires very different pathways. When you decide to value something, you might use a discounted cash flow model. It might look like a spreadsheet, but you're trying to answer 4 basic questions about your company. And no matter what the company is, these are the 4 basic questions that you need answers for. Here's the first question. My company's already made investments in the past. A company like Coca-Cola has made investments for 50, 60, 80 years. What is the value or the cash flow that I'm getting from these existing investments? These factories I've already built, the products I already have on the ground. So your first step is, what are those cash flows? Now, those cash flows reflect the earnings power of your assets. If you have really high margins and really high cash flows, you're going to give a high cash flow there. That's your base year number. That's what you usually get by looking at last year's financials, right? The earnings, the cash flows, etc. What are your cash flows of existing assets? Second step. Companies have plans for growth. The second question I'm going to ask is going to be framed strangely for some of you. I'm going to ask, what is the value added or destroyed by future growth? Notice I framed that question. What is the value added or destroyed by future growth? One of the problems I think with business schools is we're trained to think that growth is good and shrinking is bad. I mean, how many strategy classes do you talk about companies that have shrunk? Every great company grows. Growth is viewed as a good thing, and it can be a good thing, right? But growth is a trade-off. And here's what the trade-off is. The good side of growth is it makes your revenues and earnings bigger over time. That's the good side. The bad side of growth is you have to reinvest money to get that growth. You've got to build more factories, acquire more customers. You see where the trade-off is? If you spend way too much money to deliver the growth rate you're showing me, your growth can actually destroy value. If you invest just enough to justify what you're getting, growth is neutral. It doesn't add or destroy value. And if you invest very little and can show huge growth rate in earnings, growth can add value. And one of the judgments I have to make in your company is, where would I put your company? Is it a value creating company, a value neutral company, or a value destructive company? Start thinking about your company while I say this, because you already should have a frame of reference for thinking about a company. Is my company, which group does my company fall into? The third question I want to ask you is, how risky are your cash flows? Notice what I didn't ask you. I didn't ask you what's your beta, what's your risk free. Now, that might be the model that I use to bring risk in, but risk in a discounted cash flow valuation shows up in the discount rate. So I'm going to look at the risk and try to convert to a discount rate. So let's review. What are your cash flows from existing assets? What is the value added, destroyed, or done nothing to by growth? How risky are your cash flows? And then I'm going to ask you a final question, which is going to sound weird, but you're going to see why I need the answer to the question. I'm going to ask you, when will your company become a mature company? You're saying, what does it even mean, mature company? A mature company is one that grows at a rate less than or equal to the growth rate of the economy you're in. Saying, why do you need to know? Because I have a mechanical problem. Let me explain what it is. The value of a company is the present value of the expected cash flows, or the value of any asset is the present value of the expected cash flows on that asset over its lifetime. So if you have a 10-year asset, you estimate cash flows for the next 10 years, and you take the present value. A publicly traded company, at least in theory, can have cash flows that last forever. Think about that, forever. Think of a spreadsheet that never ends. None of us wants to deal with that. So you know the trick we play in valuation? We assume that at some point in time in the future, you can stop estimating cash flows and we estimate what's called a terminal value. The terminal value in a discounted cash flow valuation reflects what we think a company will be worth 5 years or 10 years from now. You say, how the heck am I going to get the terminal value? We make an assumption. It's an incredibly convenient assumption. It's one we've made already in the context of the Rio Disney theme park. Remember at the end of year 10, I assumed that the theme park would continue to generate cash flows, growing at what, 2% a year forever? I'm going to kill that dog right now, and then we won't hear the barking anymore. No, her bark is so much worse than a bite. No. But when I assume a constant growth rate forever, I get what's called an infinite, basically it's an infinite series in mathematics. Use that perpetual growth equation. Remember cash flow divided by R minus G. But to do that, I've got to assume your growth rate is constant forever. So let me complete the cycle. I started this process of asking, when will your company be a mature company? And I said, a mature company is one that grows at a rate less than or equal to the growth rate of the economy. Then I said, you need to assume a constant growth rate forever. See what the link between the two is? If I assume that your cash flows grow at a constant rate forever, that growth rate has to be, absolutely has to be, there's no ifs and buts, no maybe, has to be less than the growth rate of the economy in which you operate. Do you see why, right? If I let a cash flow grow at a rate faster than the economy, it's going to blow up. So when will you be a mature company? It allows me to stop estimating cash flows and estimate a terminal value. That's the way I think about discounted cash flow valuation. They allow me to answer these questions and put them into the numbers. So let's frame the two ways you can approach valuation. I come to you with a company, any company, a publicly traded company, a private business. When you sit down to do your valuation, you first have to make a choice. Are you going to value just the equity in this business, or are you going to value the entire business? Okay, let's step back. You have a company, it raises money from equity, it raises money from debt, it runs the business. Your first question is, do I want to value just the equity stake or value the whole business? Let's suppose you say, I want to value just the equity stake. Here's what you need to do then. You need to look at the cash flows you will get as equity investors in the company. Those cash flows obviously will be cash flows left over after debt payments, after taxes, after reinvestment. That sounds mildly familiar. That's what a free cash flow to equity is, right? So the same free cash flows to equity you talked about in the context of dividends are the cash flows you get as equity investors. But now you got to project out in the future. That's really the only difference. When you did dividend policy, you looked at the free cash flow to equity going back in time. Now I'm asking you, what will those numbers look like in the future? You know, the most daunting part of this is not the mechanics, but the imagination. You can no longer just rely on past statements. You got to make your best judgments. Free cash flow to equity is the cash left over after everybody else has been paid. You project it out, you discount it back at the rate of return equity investors need to make for investing in your shares. If that sounds mildly familiar, that's what a cost of equity is. Now, do you see why when you do valuation at the end of a corporate finance class, you've already done the dirty work? Free cash or equity is the cash left over after debt payments. Your cost of equity is the same cost of equity we talked about in the context of a hurdle rate. You discount cash flows to equity at the cost of equity. What you get as a present value is the value of equity in the business. Now, of course, there might be people who say, look, this is a lot of assumptions you have to make to get free cash flow to equity in the future. Because remember, to estimate free cash flow to equity in the future, I've got to project out the earnings growth, how much I'm reinvesting into, how much my working capital needs are. So is there a lazy way to get free cash flow to equity? If I were really lazy, I don't want to do these projections. Nate, is there something I can latch on to and say, that's my free cash flow to equity, no work at all?
Could it be like your dividends?
Exactly right. In fact, if you want to add buybacks, you could say, look, dividends plus buyback, the company has already told me what their free cash flow to equity is. Why would I want to go out and estimate it? The dividend discount model is the oldest discounted cash flow model around. It's built on the presumption, and this is a key, that companies pay out what they can afford to in dividends. You see the danger in that presumption? I showed you 5 companies, Disney, Vale, Tata Motors. But I mean, basically, none of these companies paid out what they could afford to in dividends. But in a dividend discount model, you're assuming that companies pay out what they can afford to in dividends. It's an equity valuation model, but the very narrow view of what comprises equity, just dividends. So equity valuation models, your focus is entirely on the equity investors in a business. You're saying, what other focus can I bring in? Remember, a business raises capital from both equity and debt. So let's assume this half of the class is going to provide me equity. This half is going to provide me debt. The free cash flow equity is what you get as equity investors, right? Whatever's left over. Do lenders in the company also get some cash flow? Lee, what do you think? As lenders, what are the cash flows you got from me as a company?
Would it be your interest payments?
And principal payments, right? Whatever you get from me. So you get cash flows, you get cash flows collectively. If you thought of yourself as a partnership, the collective cash flows you get is called the free cash flow to the firm. It's a pre-debt cash flow because I'm now thinking of lenders as partners in capital providing, not as adversaries. It's very counterintuitive because if you start a business and you're the owner, you don't think of the bank as your partner, you think of the bank as your adversary, right? You enter into a contract, you got to make them interest payments. I'm saying, think of the bank as your partner. They provided capital, they get cash flows, you get cash flows. The only difference is they get contractually guaranteed cash flows, you get whatever's left over. That collective cash flow is called the free cash flow of the firm. And if that is the cash flow that I'm discounting, what is the rational discount rate to apply on this? Jonathan, I'm now looking at the collective cash flow for both equity investors and lenders. When I looked at just the cash flows to equity investors, I used the cost of equity, right? But now I'm looking at the collective cash flows from equities and lenders. Do you see what the most logical discount rate for that should be? It should be some kind of weighted average, right, of what the equity investors demand, which is called the cost of equity, and what the lenders demand. The weighted average of the cost of equity, that's something we visited a long time ago. It's a cost of capital. You take cash flows to the firm, you discount them at the cost of capital, you value the entire business. People are incredibly sloppy when they talk about value. I'll give you an example. If I ask you what the most valuable company in the world is, right now, what's the answer? Leander, what's the most valuable company in the world?
The most valuable company in the world.
Give me a guess. It's one of 2 or 3 names that we all think about. They go back and forth.
Google.
But Google is close, but it's Apple. Or, people say it goes. And what do we use to measure value? We look at market capitalization. You see the problem with that? What does market capitalization measure? It measures the market value, the equity in a company, but the market value of an entire company is not just equity, but it's equity plus debt. I mean, right now, Apple might still be the most valuable company in the world with that consolidated measure. But you can already see when people talk about value, they're incredibly sloppy about whether they're talking about the value of the equity in the company or the value of the whole company. I'll give you an example, because this was actually in 2005, Microsoft and GE were competing to be the most valuable company in the world. In market cap terms, Microsoft was at about 500 billion, GE was at about 400 billion. But GE won this fight, hands down. You know why? Because Microsoft had no debt, but GE had $250 billion in debt. You add 250 billion to the 400 billion, you get to 650 billion. The value of a firm is very different from the value of its equity, because the equity is just the slice of the firm that belongs to equity investors. So let's get mechanical now. You've got two ways to approach valuation, both equity, you can either value the equity of the firm. Let's think about the ingredients we need to do a discounted cash flow valuation. And the ingredients are right there in the name, right? What do I need to do a DCF, Dylan? What are the two ingredients I need?
Discount rate and cash flows.
D and a CF, right? That's why it's a DCF. So basically, if I get the D and the CF, I've got a DCF. So let's first focus on cash flows. That's your starting point. If you decide to go the equity route and you're lazy, you're going to use dividends. It's lazy, but it's quick. You get done very quickly. If you want to get a little more expensive, you might say, I'm going to add buybacks as well and smooth them out, because buybacks might be high in some year because that's what you already can see that for US companies using dividend discount models is going to lead you to systematically undervalue US companies. Why? Because 2/3 of the cash get returned in the form of buybacks. Even if companies return what they can afford to, you're missing 2/3 of the cash flow. So I could add buybacks back. I call those augmented dividends. Basically, I'm augmenting the dividends and the buybacks. So you got dividends, you got augmented dividends. Or you can say, look, I don't trust companies. I don't believe they pay out what they can afford to, in which case you have to estimate potential dividend, which is a free cash flow equity. So when you think about equity, you can have dividends, you can have augmented dividends, we add back buybacks, or you can estimate what a company could have returned as free cash flow equity. Three measures of cash flows to equity investors. If you decide to look at cash flows to the entire firm, these cash flows are before debt payments, but after taxes and after reinvestment needs. So here's what the cash flows are going to look like. They're going to basically reflect what choice you made. If you decide to go the equity route, your cash flows are going to be either dividends, augmented dividends, or free cash flow equity. But if you decide to value the entire firm, they're going to be pre-debt cash flows. Now, before we dive into cash flows and discount rates and all of that detail, I'm going to let you in what I think is the biggest hidden secret in valuation. It's so hidden that most people who do valuation for a living don't even realize it's there. Every valuation, you're telling a story. It's not just a series of numbers. So when you give me a valuation of Carnival Cruise Lines, I know somebody in this class has picked Carnival Cruise Lines. 2020 obviously was a horrifically bad year. So you sit down to value the company. And in your valuation in 2022, you show revenues going back to where they were in 2019. And then you grow at 4% a year forever, or 3% beyond that. Are you telling me a story about Carnival Cruise Lines? Absolutely. In your story, what happens? Once COVID is done, everybody's going to go back to being on cruise lines they were before 2020. And that's giving you the value that you're getting. If you do that, I haven't worked through the numbers fully, but you're probably going to find Carnival Cruise Lines to be undervalued by about 20 to 25%. So all you do is bounce numbers back to 2019 and say, this is what it was. I'm going to just bounce it back. It's mechanical. You're going to find Carnival Cruise Lines undervalued, but it's not your model that's leading you there. It's a story you're telling of a complete recovery in the company. What could go wrong with that story? Cody? You're valuing Carnival Cruise Lines. COVID ends. In fact, I think CDC just said starting July, cruise ships can leave Florida and you can get on them. What's the problem with telling a story where everything bounces back to 2019?
I mean, you're leaving out an entire year of.
No, that's in the past though. So let's assume that you've had damage to the past. In addition to leaving out, so that I can live with, right? So 2020 was a horrifically bad year, but it's in the rear view mirror. It's a sunk cost. The damage has been done. But what else did that, in addition to affecting revenues in 2020, what else might it have affected? Could it create some psychic damage as well? People saw all those. Remember the Grand Princess or whatever, one of the, remember February 2020 when you had that cruise ship, where was it, stuck off the coast? Nobody would allow it to dock, and every person on the ship had COVID. I remember that. There's no way, no matter what discount you offer me, that I'm stepping on a cruise ship now or through the rest of eternity. I mean, I might be the exception, but I'll wager that there is a segment of the population that might have been potential cruise line customers who are saying, no, I'm not doing that. That's a petri dish for the next virus that's coming around. I don't want to do that. Do you see what a different story you could tell about Carnival Cruise Lines is? You could say, look, there's going to be a recovery, but not to 100% of what it was before COVID. It's going to be 75%. Will that affect your numbers? Absolutely, because if you're going to recover only 75%, your end revenues now are going to be far lower than they were before COVID. You're going to end up with a lower value, and you're going to find the stock to be overvalued. So I'm going to claim it's undervalued. You're going to claim it's overvalued. We're going to take the promise with our spreadsheets, giving us different answers, but it's not, right? We're telling different stories about the company. I'm telling a story of complete recovery, and you're telling a story where people will not come back to cruise ships. Which one is right? Neither of us will know until this plays out. But in every valuation, when you value a company, you are inherently telling a story. A good story, and I say this so many times, people in my valuation class are so incredibly bored of me saying it, I'll say it again, a good story is a bridge between stories, a good valuation is a bridge between stories and numbers. Which effectively means when you show me the value of a company, and I point to your revenues in year 10 and say, why are your revenues 55 billion for Airbnb in year 10? I want your story for Airbnb that justifies 55 billion in revenues. You know why the 55 billion shocked me? Because to get 55 billion in revenues, Airbnb has to have about $250 billion, 250 billion in bookings. It gets to keep about 14% of its revenues. You're saying, what's the big deal with 250 billion in bookings? The entire hotel business was $650 billion in 2019, pre-COVID. So you're telling a story, an incredibly uplifting story for Airbnb, where it's going to be not just, that's going to expand the hospitality business by drawing in new people and maybe getting 25% market share, but I want to hear that story. Every number in your valuation is to have a story attached to it, and every story you tell me about your company has to have a number that goes with it. So for instance, when Michael turns in his Coca-Cola valuation, and he shows me margins of 18%, which is where they are right now, pretty high margins. And I point to those margins and say, why are your margins so high? For Michael, the answer is pretty simple. What keeps Coca-Cola's margins high?
Their brand.
That's it, right? It's not the taste. You can keep the syrup ingredients for all I care. The brand name allows them pricing power. The pricing power gives them high margins. So any story you tell me about a company, it's great brand, it's great brand, it's amazing management, it's loyal workforce, remember we talked about ESG, that your company is a good company, or Patagonia. So where are you going to show it? I have to find a number that attaches to your story for your valuation to make sense. Valuation is as much about building a story for your company that you believe in as it is about knowing the mechanics of how to convert that story into numbers. Any questions about the storytelling aspect? I actually, about 4 years ago, I wrote a book called Narrative and Numbers, entirely about this. It's actually it was one of my favorite books to write, because this wasn't about how do you compute the reinvestment rate. And what's a return on capital, which, as I said, are they're boring topics to write 50, 60 pages on. This is about stories. Now, how do you value an Uber, a Palantir, an Airbnb? It's really the story that's driving evaluation. And I wrote that book because I was concerned about what I was seeing in valuation practice. I mean, I've been teaching my valuation class since the mid-'80s. And if you think about it, we have, in terms of data, we have a lot more data now than we did 37 years ago. Our tools are so much more powerful now than they were 37 years ago. But here's what I think is the most ironic part of this whole process. Valuations, as I see them, have actually become less good than they were 37 years ago. We have more data with more powerful tools, but somehow it's making our valuations less good. And that's the contradiction that led me to write the book, because I think what's happened is valuation has been taken over by spreadsheets. We've become Excel ninjas. We work with spreadsheets. We've forgotten the storytelling side of valuation. So as you value a company, I know you're not going to get a full chance to delve all the way into the mechanics of valuation. Remember, you're telling a story about your company as you're valuing the company. Priyanshu?
Yeah, Professor, I have two parts of questions. First is the narrative which we create are generally subjective to the narratives which we hear from the management. So is there a way to actually ensure that our narrative is more correct? And
Ensure, see, first, let's take the word ensure and correct out of this discussion. You know why neither word belongs? What are we both trying to do? Management tells a story about the future. You tell a story about the future. You're both trying to do what? Predict what's going to happen in the future. And let's face it, neither of you is God. So you're both going to be wrong. So all you can do is ask, and I call this the 3P test, and I go through this in my evaluation card. Is it possible? Is it plausible? Is it probable? You're trying to make sure the story you're telling passes through those. So if let's say the management at Carnival Cruise Lines is telling a story of a full recovery by 2022. And you look at that story and say, no way, and you say 75%. Is one of you right and the other wrong? No, right now we don't know. The question is, we're going to start to accumulate evidence as we go along, right? As cruise ships open up, you're going to very quickly start to see whose story is more plausible. Which also means that your evaluations are never quite done. You constantly leave the door open saying, maybe I got the story wrong. So don't think of this as a one-time deal. You listen to management, you frame your own story. You know you're going to be wrong 100% of the time. But you know what your consolation is? You get a chance to revisit that story. And every time you read a new story about the company, it gives you a chance. It makes valuation a lot more fun and interesting, because it means that this is basically about framing a story that you could buy into. So let's bring all the ingredients you will need mechanically into valuation. So when you think about valuing a company, you first need cash flows. You're going to always start with last year's numbers, but you need cash flows for the future. Your cash flows can either be after debt payments, which will make them cash flows to equity, or before debt payments, will be cash flows to the firm. Second, you need a growth rate in these cash flows. If you're looking at cash flows from an equity investor's perspective, that growth rate will be a growth rate in equity earnings, equity cash flows. But if you're valuing the entire firm, your growth rate will be in operating income, not equity income, and operating cash flows. So your perspectives on both cash flows and growth rates are going to be different depending on whether you're wearing the equity hat or the firm hat. When you look at discount rates, the difference becomes even starker. If you're wearing the equity hat, you're valuing the equity, your discount rate is the cost of equity. But if you're discounting the entire firm, looking at the cash flows collectively to all investors, your discount rate has to be the cost of capital. And finally, with both these approaches, at some point in time in the future, you got to stop. And you can stop only if you're willing to assume that your company is a mature company, that growth rate can continue to forever. Ultimately, every discounted cash flow model revolves around the same levers, but the way you compute those levers will be different depending whether you're valuing the equity in the firm or the entire firm. So I know we're getting to the end, but let me start off with what we're going to start Wednesday's session. The first stop in discounted cash flow valuations should be with cash flows. And it should be with last year's cash flows. Before you get ambitious about the future, let's get last year's cash flows nailed down. And as I said, the cash flows can either be cash flow to equity, which are defined as either dividends, augmented dividends, which is dividends plus buybacks, or if you want to do the hard work yourself, it'll be the same measure of cash flow we used for when we used to look at dividend policy, potential dividend, which is free cash flow to equity, all cash flows to equity. If I'm doing cash flow to the firm, I start with earnings, but no longer net income. And you can see why. Cash flow to the firm is a pre-debt cash flow. So I cannot start with net income because that's after interest expenses. So I climb the income statement and start with operating income, earnings before interest and taxes. I act like I pay taxes on that operating income. Notice the word I used, act, because I know I don't pay taxes on operating income. I pay taxes on taxable income. I act like I pay taxes on operating income. And then I subtract out net capex and change in working capital. It's free cash flow to the firm. Compare those two measures of free cash flow to equity, free cash flow to the firm. And you're going to see the only real difference is one is after debt payments, the other is before debt payments. And that distinction is something I hope you take away from this class, because people are so incredibly sloppy about the word free cash flow. I've heard people say free cash flow, the free cash flow in this firm is 100 million. I have to always stop and ask, is it to equity or is it the firm? They have no idea what I'm talking about. Partly because they haven't thought through it. So be explicit. When you say free cash flow, always complete the word to equity or to the firm, because that difference makes a huge amount of difference in what you see as cash flows. So on Wednesday, when we start, we're going to finish the process of discounted cash flow valuation. But I'll send you, I've already sent you the link to the spreadsheet you can use to value the company, but I want you to start thinking about the story for your company you're going to tell to value your company. And guess what? You already have most of the ingredients for your story. You collected them along the way, but those ingredients are going to play out as a story. The story is going to play out as numbers in your valuation, and a value will come out. And I'll cut you a lot of slack on the valuation part of this project, partly because it comes at the very end of the class, and I don't expect you to be, able to spend very much time. But I want you to get at least comfortable enough with the mechanics that this summer, if you have to work in some place where valuation is part of your job, you can go toe-to-toe with somebody who's taken a valuation class and be able to handle the details. But trust me, there isn't that much in valuation that's beyond what we've done already in this class as corporate finance. Okay, any final questions before I sign off? Okay, I will see you on Wednesday.
Thank you.
Take care.
Thank you.